G'day guys, welcome to the channel. My name's Tim, and on today's episode, we're taking a look at the stock market crash that we're currently in. We'll be looking at a best case scenario, a worst case scenario, and somewhere in between. And we're going to be comparing the current market action to what happened in 1929 and also the period throughout the 70s. We're also going to be looking at what the Fed is doing and what may have caused this market to accelerate over the last 11 years. All right, let's get stuck in. So first of all, on the screen, what I've got here is the macro charts looking at the monthly price action of the Dow Jones in the 1929 period and also the modern day. So both of these charts are looking back over about 20 or 30 years worth of data, and they're on a very similar scale. The red line is the 25-year moving average, and the blue shaded area is the 2.5-year moving average. Okay, so the first thing I'd like to draw your attention to is this trend line here. We can see that leading up to 1929, we bounced off it here, and then we had the big run up, and then we crashed down to that same declining trend line, and that was an 89% drop from the top. And you can see we crossed through the 25-year moving average. Now, it looks very, very similar to what the chart looks like now. You can see we bounced off it here, and then we've had a big run up. And if we do drop to that same trend line, it will be an 84% drop, and it will cut through the 25-year moving average, just like it did back here in 1929. Okay, so that's a worst case scenario following the Great Depression crash. A best case scenario is that we land somewhere here on the 2.5-year moving average, this blue shaded area. You can see that we do tend to bounce off this area quite a lot. So in fact, over the last 10 years or so, we've bounced off it a couple of times, and this has been the bottom of the market each time. Another scenario, somewhere in between, would be a 50% drop. And that would be if we actually touch the 25-year moving average. So this is the 1970s. So from 1966 to 1982, basically a 17-year time span, the market just went sideways. You can see it has bounced, had crashes, and bounced. You'll notice again, though, that this trend line, this declining trend line where we have a crash, followed by another crash, followed by another crash. Now, in 1974, we actually came down to the 25-year moving average, and then we bounced off it again and again. And in fact, this was kind of like an inverse head and shoulders. We shot up with a 17-year bull run following that period. So going back to the modern day, it is very possible that we do interact with this 25-year moving average. So one scenario is that we do come down to it like that before bouncing off, and that would potentially give us this head and shoulders pattern as well. It's a little bit on an angle. So those are the three scenarios. We either have a 15% drop to the 2.5-year moving average, we have a 54% drop to the 25-year moving average, or we follow the same pattern as we did in 1929 and we have an 84% drop to this trend line. So those are three possible scenarios, and we don't really know how it will play out. Okay, now the last thing I'd like to draw your attention to is this period here. What I've done is I've zoomed out. So we're looking right now at about 100 years worth of the Dow Jones. There's the 1929 crash. This is the 1970s period, and this is where we are now. So you'll notice that from around 1942 to 1966, we went up 17 years. And then from 1966 to 1982, we went across 17 years. And then from 1982 to the year 2000, we went up 17 years. And then from the year 2000, we went across here about 11 years. Now, if we followed a similar pattern to what we did in the past, we came down to the 25-year moving average, just like we did in these occasions. But this time, we didn't quite make it, but instead we started to accelerate off, and we now went up another 11 or 12 years. And I always wondered, why didn't we come back and just touch it one more time before shooting off for potentially another 17-year bull run if we were to follow this same pattern of 17, 17, 17? We could have gone across, another 17, touch it, and then shoot off for another big bull run. Why didn't we do that? What happened during this period right here that was different from this period down here? Well, I think I might have an answer. What I've got on the screen right now is the Federal Reserve total assets less eliminations from consolidation. And you'll notice that right around here, right at the bottom of the great financial crisis, they started purchasing securities. And if you notice, they also right here around the 2020 turmoil, they also accelerated their purchases. And this basically correlates to the bull run that we've had over the last 11 years. These figures here, we're talking about close to $9 trillion worth of assets the Federal Reserve has purchased during this phase. And this has really pumped up the markets during the last 10 or 11 years. So if there seems to be a correlation that when the Federal Reserve is buying assets, the market is going up, what happens when this chart starts coming down? And this chart will start coming down from June this year. Here are the plans from the Federal Reserve website, and they're talking about how much of the securities they'll be selling over the next few months. You can see here that they're planning to sell $30 billion of Treasury securities per month, increasing to $60 billion per month. And they're also planning to sell mortgage-backed securities starting at $17.5 billion per month, increasing to $35 billion per month. So with the Federal Reserve selling securities that they've been purchasing throughout this region right here, the fact that interest rates will continue to increase month after month in the year 2022 and possibly into 2023. The fact that inflation is currently at 8.5% and the Fed need to get it down to about 2%. The fact that the markets are overvalued at the point right now compared to what they were in the past. This leads me to believe that we are unlikely to stop at the best case scenario around the 30-month or the 2.5-year moving average. It is more likely, given all those factors, that we come down further. And that could mean either a roughly 54% drop to the 25-year moving average, and we haven't touched the 25-year moving average since 1982, right down here. And we look at other clues like Netflix dropping 74% in 6 months. Or Meta, Facebook dropping 47% in 9 months. Or the Nasdaq as a whole dropping 25% in 5 months. These are some of the clues that may indicate that we are going to drop way past the 2.5-year moving average and come somewhere down into this region. Maybe you're in the 50% region, and worst case, down in this 84% region. And lastly, one thing I'd like to talk about is crypto and Bitcoin. Now, what I've done on this chart, this is the NASDAQ 100, and I've overlaid the dates when Bitcoin has peaked in the past. This is the 2011 peak, the 2013 peak, the 2017 peak, and the 2021 double peak. And you'll notice with Bitcoin, even though we've had bull runs and bear markets for Bitcoin, on a macro level, the tech stocks have been in one continuous uptrend this entire time. The NASDAQ has been bouncing off these moving averages in an uptrend for the last 10 or 11 years. And even in that time, Bitcoin has still dropped around 80% each of its bear markets. Now, what happens now when the macro trend is down, when we're in a macro bear trend? Is Bitcoin likely to peak in this type of environment? Anyways, I'd like to finish the video there. The future hasn't been written. Anything can happen. These are just a couple of possible scenarios looking at the charts and drawing lines on the screen that might show us where we may go. This video is not financial advice. It's purely here for entertainment purposes and just to identify a few potential scenarios. Anyway, I hope you enjoyed that video. Until next time, I'm Technical Tim, and cheers.